In this video, I will be looking at how you can get more out of a seasonality-based trading strategy, including filters, stop losses, profit targets, out of sample testing, and analyzing drawdown. This is Mark from tradinginformed.com and welcome to this video on how to get more profitable trades using seasonality part 2. This video is the second part in a two-part series looking at how seasonality, and in particular trading on specific days of the month, can boost your trading strategy, whether you are a day trader, a swing trader, even a position trader, anybody who is trying to time the financial markets. In the first part of this video series, I introduced the concept of trading on specific days of the month, and if you haven't seen this video, there is a link on the screen and below this video. I showed that using the S&P 500, we can look for the patterns that occur during a typical trading month and take advantage of that by only trading specific days. You can see on the screen the seasonality pattern that I am interested in. In the middle of the month, there is a hump where days are more likely to be profitable. And again, we see a similar thing towards the end of the month that goes into the start of each new month. So I have taken this information and I have put it into a backtest model. You can see on the screen at the moment the backtest model that I have used. Now this is a trade-informed backtest model and it is built in Excel, and it is a way to test all sorts of different trading strategies, different markets and time frames, and you can use it to test your trading strategies, help you hit your trading goals, just simply to make your trading easier. If you want more information about this backtest model, there is a link on the screen or down below this video. Now, the trading strategy that we're looking at today, as I have said, is based on trading days. Now, I mean trading days of the month, starting from the first day of the month and counting upwards, excluding weekends and holidays. So when I said we are trading the end of the month, we are trading here based on entering on day 19 and we are exiting on day 3. We're also entering and trading that middle of the month hump, and so we're entering on day 8 and exiting on day 12. Now all these inputs are variables, but I am leaving them in this situation because, as you can see, I am testing up until 2015. Now why I'm doing this is so we can have some out of sample data. We can refine, optimize the model how we want it for this time period, and I am using the last 3 years worth of data as my out of sample test. What I said is we're going to look at different scenarios. So the first thing I want to look at is some stop losses. Now you can see I've set these values to 100, which means in this case that they're not being used. But I can easily change these, and you can see as I scroll through a profit target using an ATR multiplier. I like to use the ATR because it adjusts to the market. It adjusts not just to the size of the market, the type of market, but also the volatility that is occurring at any particular time. So you can see here, with reference to the results, that we're not getting a lot of value out of a profit target. I tend to prefer using profit targets in my own trading, so I may well use one around 3 or 4, but we can see that over the time period of this analysis, it's not really helped or improved the results. We can do the same thing with a stop loss. Now this is a simple stop loss. We can set this to 1 times the ATR, and you can see immediately, visually, how it affects the capital graph, and also our maximum drawdown, and also CAGR, which stands for compound annual growth rate. Now if I was to push out the stop loss, we can see that the capital graph returns to something pretty close to what it was without any stop loss. But there's one other variability that I would like to show you that I've put into this model, and this is to use what I'm referring to as a closed stop loss. This is, instead of exiting at the market when we hit our stop loss level, this is exiting at the end of that day. So we haven't got a hard stop loss in the market, but if our stop loss level is hit, we will exit at the end of that day. So I've clicked that on as a scenario, and you can see here we have made a small improvement to the trading strategy. If I go through here, you see we've got slightly lower drawdown, and our compound annual growth rate, net profit, has stayed the same. So this is one option that is interesting to note in the development of this particular trading strategy. Okay, so the next thing I want to look at is a number of other scenarios. First thing here is trading the next day open. Many traders are not able to trade at the close, which is my preferred time of day to trade on the daily time frame, but they would like to open in the next day. So if I click this, we can have a look. Let's check the right one. We can have a look what this strategy would look like if instead of trading the close, we trade the following open. And we see we're not making a lot of difference to the strategy. Let's be fair and set that back to 100 here. We're not making a lot of difference whether we switch this on or off. In fact, we can see a very small increase in net profit, but probably nothing significant at all. So this strategy can work equally well trading the close or the open, which is a useful feature for some traders. The next filter scenario I would like to have a look at is one that is hugely popular, including famously used by Paul Tudor Jones, hedge fund manager, and that is the 200 period simple moving average. So I check this box. We can see how the strategy performs above the 200 period average. And somewhat surprisingly, to me at least, again, it is not making a big amount of difference in the strategy. One thing we are getting is slightly lower drawdown, and that is very, very important. We ideally want trading strategies with low drawdown, because even if we have lower profit, we are more likely to stick with those strategies when times get tough. We've got a good percentage of winning trades and slightly lower compound annual growth rate. Another one of my favourite filters, the linear regression. In this case, the 200 period linear regression. When this line is pointing upwards, then we're going to take a trade. And again, you can see we've got similar enough results, slightly higher percentage of winning trades, similar net profit, and growth rates, drawdown, similar. And finally, we can have a play around with fast EMA greater than slow EMA. So what I've got set up here is two different EMAs. We've got the 50 and the 200. And you can see that the classic golden cross filter here has produced a decent enough strategy, improvement on the strategy, although lower net profit. But we can quite easily test this further. We can do a very small or very fast EMA against a very slow one. We can put this down to 25. we could say the 1226, the common MACD numbers. And you can see each of them have an effect on the strategy, on the net profit, and the capital graph. But interestingly, to my mind, none of them are making a huge difference, so it comes down to personal preference. Now, if you want to compare any of these strategies together, we can easily do so. So if we want to have a look at, now let's have a look at the 200 period SMA. If I click on here, and linear regression, click on here again, go to strategy review, you see we have the two strategies here. So we have the 200 SMA and we have the 200 linear regression. And we can compare them directly, and we can see here there isn't an awful lot to compare. Both of these scenarios are very similar. So I'm going to go back to the results again. I said at the start I'm going to look at out of sample testing and how I'm going to do that. First of all, let's get back to our original scenario. These original days were selected based on data up until 2015. So I'm going to look at the past 3 years. So I'm going to change this date here to 2015, and I'm going to change this date to 2019. And here we have the most recent period of data. You can see this slightly more clearly if I go into the annual analysis tab, and you can see what we've got here. We have most 2015, and we can compare it to the market here. Now this is buy and hold we're comparing it to. 2015 was a tough year, 0.2% for the market, practically flat. Strategy returned a bit better than that. The recovery year here, interestingly, was not matched by the strategy, but the booming low volatility 2017, which saw the market go up 20%, was more than matched by the strategy. And more importantly to my mind, when the going got tough in 2018, volatility returned, the VIX spooked the market. We only have a relatively small 2.3%, and compared to many hedge funds, many big traders and investors, that is a pretty reasonable return for that year. And we can see in the uptick we have had so far in 2019, we have captured a decent part of it. So let's go back here again to the results. Now, we don't want to optimize the strategy using our out of sample data. We want to optimize using our in sample, which is our earlier data, and then just to see the results in our new data. But for the purposes of this video, we'll assume we have this strategy optimized. We're not going to change it again. I'm just going to stick this on here so we can have a look at all the data and how the strategy has performed since 2000 up to 2019. And we can see that looking at the capital graph, at least with no scenarios, no clever filters, we've maintained it. We had the run up here, which was 2017, the volatility of 2018, and we've done pretty well compared to the market. Now remember, this is not a clever trading strategy. This is just opening and closing on specific days of the month. I hope you enjoyed this video on using seasonality to improve your trading strategies, on how we can use statistical, quantitative data to give us an edge in the markets. If you want to see more videos like this, please hit the subscribe button. Also like this video. And if you want more information about trading the financial markets, please go to www.tradeinformed.com.